Welcome to Multiple Perspectives. I'm David Lofgren, along with my frequent co-host, Daniel Brereton. Daniel, welcome.
David, happy to be back again.
So you've got a conversation that you recorded that you're going to share with us here with Christopher Lustrino, who is the founder of KingsCrowd, right? Tell us about that.
Yeah, KingsCrowd. It's an interesting platform. You know, Chris founded the company back in 2018, I believe, and he started it off, not hoping to make a investing platform, not hoping to, analyze individual deals and offer them to investors. But I think the common theme that we're seeing with a lot of people that we speak to is he was looking to share the information that he had with a community. He started off with a site which reviewed or analyzed various investing platforms. You might have seen the various platforms that are out there for different types of alts. And he really wanted to dig into which platforms were doing it well, which platforms were not doing it well, and really started to build a community around building trust in these types of platforms or helping people understand which platforms were good. And based off of that, a couple of years later, he really took all the lessons learned that he had. He had an insider scoop with these platforms. He had analyzed them in and out, knew what worked, knew what didn't, and decided to launch his own platform. And on that platform, he really focused on private equity and different private market investments that could be available to investors. So I think what he and I are going to get into with this interview is that it's really interesting to build that community and build that trust with investors. And sharing the knowledge is really, really important in private markets because still they're fairly private, and it's really hard to get clear information. And having that trust and that transparency with platforms and really building that confidence in your ability to pick the investments is so crucial to success in the private market real estate arena.
Right. Yeah. It feels like since, private markets have opened up somewhat to investors, there have been a lot of people who are stepping into the void of trying to help, investors or prospective investors unpack sort of what each of these different asset classes, what each of these different deals within each asset class, what they offer, try and help people figure out, how to think about this stuff if they don't have too much exposure already to private markets or to alternative assets. I wonder, is there anything specifically about Chris that sort of sets him apart from the others?
Yeah, it's interesting. He's obviously very knowledgeable when you speak to him, and he has that depth of knowledge in private markets and private equity, and having done it for so long as an analyst and now a founder and CEO, it's very clear that he's passionate about these markets. But it's also, I think, in a cautious way, moving forward in a very measured and methodical manner, which is also incredibly important when you're dealing with investments in general and private market investments in particular. Not diving too quick into it, not trying to catch a quick trend, but you see he's gathered information on private market platforms, then he builds a platform based on what he's learned. He gathers information about private investments and then builds a platform for those various investments, and now expanding into different asset classes, talking to other people. You can see that network building and that knowledge density really building, which is really what he levers to build on his platform. And I think it echoes with the rest of platforms that investors see, which is those that might be a little slower moving or slower to adopt new types of technology or new types of investment asset classes are the ones that tend to win in the end. We saw some fast-moving players in the private market space in the early days, and of the majority of those investment platforms are no longer around. But platforms like Equity Multiple, KingsCrowd, these are investment platforms which have weathered the storm, and they've been steady Eddie through this turbulent period. And without predicting the future, I think that business plan tends to pay off.
Right. Yeah, you got to love anyone who's coming to this space, as an educator who wants to help people understand and unpack all of these potentially, complex deals, but, that someone who maintains the approach of being a student as well, keeping an ear to the ground, trying to understand how things are evolving and sharing that knowledge along the way. Something that both you and Chris sounds like you're both experts in that field. without further ado, let's listen to the episode. What do you say?
Let's hear it. Let's put it on. Chris, welcome to the show. Happy to have you on Multiple Perspectives.
Oh, thanks so much for having me, Daniel.
Yeah, we like to have all sorts of different founders on talking about their journeys, their stories, financial independence, different types of assets. So I think, hearing from you with your story with KingsCrowd, you founded that at a time when online capital raising was, still really niche, right? I think, 7, 8 years ago. And I just want to know, what was the inflection point or the thing that gave you the conviction to start that platform?
Yeah, it's a really interesting question. I came from a traditional kind of private equity background. I was working in a consulting firm where during my almost 3 years there, I did about 32 diligences on, all the major name kind of private equity players. We would do a full workup on the businesses they were acquiring. And, I'm sitting there as an analyst, right? Getting my butt kicked, working 50, 60, 70, 80 hours plus a week, and spending hundreds of hours diligencing these deals and realizing, wait a second, I have no path to actually accessing or investing in these deals. And I thought that was insane. And that was really the aha moment where I literally Googled, why can't I invest in private markets? And stumbled upon this whole new world that was emerging thanks to new technology and the Jobs Act, and all these things were changing, right? But this was 2014. The Jobs Act hadn't even been fully enacted under regulation crowdfunding until 2016. So I ended up starting a blog in it actually and meeting every founder and CEO that was building something in this market, whether it was Fundrise or Ground Floor or Republic and WeFunder, all those guys, right? I had on my blog and was doing profiles on their businesses. And, the more and more I chatted with them, I think I was 40 or 50 or 60 platforms deep when I started feeling really compelled, like, man, I need to build something in this market. And then fortunately or fortuitously, one of the founders of Napster saw it from a company I was actually covering that he was advising. And he said, hey, you seem really knowledgeable in this market. There's few people talking about it. Would you want to really build a company in this space? And that was the impetus to say, all right, I'm 25. I don't know anything, but let's give it a whirl.
Well, it's funny. You talk about, your blog, and a lot of the good conversations I have, and, I'll say it on the real estate side, the community driven people are the ones that really stand out and really successful. So, what was it like sharing all of that that data or that research that you're putting onto your website? And, what sort of community did you develop with that website you created?
Yeah, well, so for KingsCrowd, right, we've now had 4,000 investors back us with almost $7 million. They have been the key capital resource that has helped us grow our business, which I think is pretty incredible. And it aligns so well for us to raise capital from our own community because these are the people who are actively investing in private companies, in private debt, in private real estate, and love what we do. And so it aligns so well, and it's also helped us learn so much along the way. But I will tell you, and I'm sure you've all experienced this, it's funny, in traditional private markets, it's so opaque that you kind of hide behind these walls or these shields. Putting yourself out there in the way that we're putting ourselves out there today, it can be intimidating, right? And people are going to grill you more, and there's so much transparency. You can't hide when you have weaknesses or issues or challenges. It's all out there for people to evaluate. But I think in doing that, we've built an incredible amount of trust with our community and really created a community of fervent investors who love what we do and stick with us, which is pretty cool.
Yeah, it's that virtuous cycle, right? And I think you might have described it before as this flywheel effect with the investors, the founders, your platform, and feeding back into each other. And I guess how do you see that investor go full cycle? Someone who's just trying to get into private markets, just trying to learn more about this, but then they get their feet wet. What's that life cycle for it, and how does it create that virtuous cycle?
It's pretty interesting. So, an individual historically has come to KingsCrowd, one of a few ways. Either A, they have buyer's remorse, right? They've made an investment on a Republic or a WeFunder or a Start Engine or Net Capital, and now they're going, was that a bad idea? Did I just make a major mistake? And so literally the Google searches are, is this a bad investment, right? And it's the company name, and we often pop up first because we're the only people really providing that comprehensive research and coverage of all these companies. And so they'll learn about us from that. And either we solidify that, hey, you know what? The fundamentals look all right here. Or we show up all the red flags and maybe they have an opportunity to get out before the investment closes. And they're super thankful. They're like, I didn't know you existed. I need someone like you. I need someone else out there looking out for my best interests and helping me evaluate these companies. And the other way is folks who are really interested in private market investing, have heard of this space, but feel the need to be educated on it in order to feel confident to navigate these waters. And those folks are finding us through our podcast, through our investor roundtable content, through our educational blogs, soon to be our KingsCrowd Academy. All of these things, everything we do is just education on how to navigate startup investing and private market investing, and what is private equity, what is venture capital, what are the fundamentals you should look at. And it's all of those things added up that really get people trained up. And then they go, okay, I feel like I can do this. And now KingsCrowd has all the tools there for me to navigate this space. And then they start getting into it, right? And we help them, whether it's their search or their due diligence of the deals. Then they go and invest. Then they could track all their deals with us. And then they see there's an opportunity to invest in KingsCrowd, or maybe even our fund, KingsCrowd Capital. And they just keep realizing there's more and more here for them to be able to work with us. And what we hear from so many of our like super users at KingsCrowd and the people that love us is they want KingsCrowd to be the one-stop shop other than the transaction into the company on a start engine or WeFunder. They want to be able to live at KingsCrowd and do everything they possibly need to create their portfolio of investments and manage them, which I think is a really cool spot to be. And in doing that, again, we have that opportunity to build that trust.
Yeah, and the world of private markets is only going to get bigger, right? You talked about doing the due diligence. I guess one of the interesting sides to flip the script a bit is, I guess, what's an investment that you remember, feeling really confident in, and then at the last second you did one piece more diligence and you just you saw that it wasn't the right investment for you.
Yeah. Well, actually, I'll go a step further and tell you one where I should have done that and didn't. And it was interesting early on. People, in this market, right, in regulation crowdfunding, regulation A+, where now you can invest in private companies, right, including Equity Multiple that did a raise a couple of years ago. Historically, that's not accessible to you, right? So when this becomes accessible to the general public, a lot of people had a lot of questions about the validity of companies raising the space. There must be a negative selection bias, all these things, which prevented some really good companies that would have been interested early on from raising, who had venture backing stuff, because the venture capitalists say, I'm not sure you should do that, right? And but little by little, we started to see those first companies go, no, this is a really good path. We should be doing this. And I remember it was one of the first venture-backed companies that decided to do a crowdfunding raise. And this is back in, I think, 2018. When they were, I forget the firm they were even backed by, but it was a real estate like brokerage platform. And I remember looking at it, it was like, man, they're burning a lot of money, But it was like this new innovative idea. They had venture backing, and everyone got so excited at this idea that we were getting into this venture deal. But I was concerned because the guy had failed twice before. He had no successes yet. And one of the main venture backers was actually his brother and, or brother's firm. And I knew, like, just fundamentally it seems unsound, but I wanted to think, hey, I'm a part of one of the first venture-backed deals in the space. I'm going to go with it. And sure enough, it flamed out in like a year and a half's time.
Oh, wow.
But now almost 40% of the market is venture-backed companies. So it's grown pretty tremendously.
Yeah. And, with the whole venture and private equity and this private markets world, there's, I guess, some core asset classes. When you look at the types of companies that, you were covering as an analyst when you were just starting out, and now with everyone sort of having access to these types of capital sources and investors obviously having access to these companies, what are the main types of companies that you see, and what are some of the newest company types, industries, or sectors that you're seeing show up on the platform?
So that's one of the coolest things about this market. If you take a step back, right, prior to the financial crisis of 2008, right, it was not uncommon for a small or medium-sized business to be able to go into a bank and get the capital they needed to grow their business, right? After 2008, that all like completely and totally goes away. That's just not a thing anymore. So what were we left with? Venture capital, which is focused on one thesis, right? Every venture capital is focused on one thesis. Find the billion-dollar unicorns, right? Or more. But what if you're a small business that's trying to become medium, or medium that's trying to become large, or small that's trying to become large, right? You can make an incredible amount of money. And frankly, a lot of private equity investors and even kind of private wealthy individuals make the most amount of money playing those bets where they're investing in a company with 2 million in revenue, a really good valuation that they think could sell for 30 to 40 million when it hits 15 or 20 million in revenue. And companies that are doing 20 million in revenue that they think could grow to 100 million in revenue and sell in the next 5 years for 125, 130 million dollars. Right? And all of these other things. That is like really, really interesting investment opportunities, but venture doesn't invest in that. And private equity, the only way they invest in it is if they're pretty much doing a majority buyout. So it's like the capital stack is incredibly empty when it comes to small, medium, and large size businesses that don't desire to go on the unicorn path, right? There's almost no really fundamentally sound ecosystem of capital providers outside of like debt capital markets. So what's really interesting for me over the past few years has been watching the number of companies coming into our sector that look a lot like the companies I was looking in for private equity, where they're doing anywhere between $200 to $300 million in revenue. And a lot of these companies are even profitable or have a very low burn rate and are growing really well. But again, don't fit the traditional venture profile, but are incredibly strong investments, especially if priced right. So we quite literally see, 20% or so are kind of your day zero, Y Combinator back, venture style type investments in the market. And then you kind of have this, 30 or 40% that's easily that small and medium sized businesses that have a really large growth trajectory where you could make 5 to 20x your money. And then you have these large businesses that are actually prepping for IPOs in the next couple of years. They might be doing 3 or 400 million in revenue and are really profitable and are just trying to build up their cap table as they prep for an IPO. So that's what's been so interesting is just the breadth of companies that we're seeing in the market is like really, really fascinating. In terms of sectors, two that we have seen just a ton of, and I don't think people would have thought would have done really well, are healthcare and kind of clean energy technologies, whether it's battery technologies, new sources of energy, so on and so forth. Healthcare is just such a large part of the GDP, right?
Yeah.
There's a ton of opportunities out there, but another one of those kind of overlooked areas where the capital isn't getting to is especially in like the biotech sector when there are these early day companies, right, that aren't ready for phase 1 or phase 2, that don't have enough data to get kind of the more established VCs to come in. And the only other way to fund your business to that point is really through grants. And now they have this new resource where we're seeing projects come out of Harvard and Stanford and all these places that are using this as a way to fund their businesses to get to phase 1, to get to phase 2, to then go into those big licensing deals or venture investments. So those are some of the categories that I've been pretty surprised by and have done very, very well with investors.
Yeah, well, it's funny you mentioned, healthcare, biotech, and those other companies because, those tend to be, some smaller companies. You don't start a biotech company as $1 billion company. You maybe have a small idea that grows bigger and grows bigger. And I guess across the capital raise, across the business cycle, you're going to need different capital needs at different times. So, but I always see it as well. A double is a double, no matter where it comes from. Whether it's $1 billion going to $2 billion, or it's a $100,000 company going to a $200,000 company, it's still a double. So I think that there's a lot of opportunities that, for want of a better word, are not the sexy, finding the Airbnbs of the world or finding the next Uber, but there's a lot of interesting companies out there that have fairly strong growth. And for us at Equity Multiple, I think we're covering something very similar, right? We're not the Blackstones or the KKRs of the world going out for the billion-dollar development deals. It's, the middle market where, the institutional capital is not really going to come down because it's too small, but the retail capital can't necessarily do it themselves. So you have to have, this access point for either crowdfunding or, smaller institutions to come in with the capital.
No, that's exactly right. And that's exactly what we see. And I think it's so important to know, like, the capital stack is deep and there is a very large breadth of companies out there with all sorts of different investment profiles. And one of the cool things is I absolutely still, think from my own perspective, for my own self, is like, I like making those kind of venture bets. That's a part of my portfolio, right? And I make those. But then I also like making those kind of risk to reward decisions of, hey, here's some mid-market companies. I'll give you an example. We invested in a company called Advancing Eco Agriculture that had been built through bootstrapping and never raised a dime of outside funding, that was doing around, I want to say, over 18 million in revenue and 3 million in EBITDA. It really looked like kind of a traditional private equity style company that's looking for an exit in the next 3 to 5 years, and like totally different profile. but a great opportunity for a really nice return, especially with where it was priced. And those are the types of things you can find in this market, but you have to be thoughtful and willing to take the time to go and identify. One of the greatest challenges is that there's 600 to 800 deals every day just in this private equity landscape that you can invest in. So, that's where we come in, right? And we do help people kind of navigate these waters and be way more efficient in their due diligence process.
Yeah, and something with the private capital markets evolving, it almost feels like we're getting these standardized methods of doing private markets, which it's not SEC standardized, but it's best practices. And I'm curious because I think that private markets are going to get to the point where you've got an entire capital stack, which is going to be strange capital, to say it in a strange way. You could have a crowdfunded private equity section. You could have a private credit section, again, crowdfunded. How do you think it's going to evolve with, platforms like KingsCrowd, where you get a lot of different capital sources that are sourced from non-traditional means?
There are $13 trillion in private market transactions in the United States alone that occur every year. That includes everything from private equity, private debt, consumer credit, private real estate, whether it's multifamily homes, single family homes, commercial real estate, so on and so forth. What I tell people all the time is do you truly believe that that's going to live offline for the rest of the time? We're just going to all continue signing pieces of paper and wiring money to institutions, and it's just going to stay in this archaic method forever. Public equities at one point didn't exist, right? You wouldn't be able to access the public equity markets as an individual. That wasn't a thing, over 100 years ago, right? All these things eventually evolve, and technology plays a role in making sure that that's possible. Just look at all the marketplaces that already exist today. You have, nearly 60 or 80 Reg CF type platforms out there. You have broker dealers starting to get into the space. You have dozens and dozens of real estate platforms like yourself that are out there. You got platforms like Percent for private credit. You got, racehorse fractional share platforms. You got collectible platforms. You have all these things. And what does that tell you? It tells you that we're moving to a world where private market assets become digitally native and are going to be opened up to the general public in a way that looks and feels like public equities. And if you just look at all the wording that the Robinhoods and the Fidelities and all these big folks are talking about, it is very, very clear that the next frontier of growth for all the mega asset managers is alternative assets. So even if 30, 40, or 50% of this stuff becomes digitally native in the next 10 to 15 years, you're talking about $6 or $7 trillion in private market transactions in a digitally native setting from all of these new types of investors, right? The retail environment. And then we're not even talking about the fact that we'll start to see layered on secondary markets. We're already starting to see them emerge, where quite literally you'll raise money on one of these platforms, and then you'll actually make those shares available for sale at any given moment in time via the secondary markets built directly into them. And Start Engine has already built this. And we're starting to see, a little bit of volume on those platforms. That's going to be the future where not only do you have these private market transactions on the primary side, but the liquidity aspect is going to grow pretty significantly too. And I think that'll only create greater velocity and a far larger market than we already have today.
Yeah, I like the way that you frame that too, digitally native, right? It's not trying to make private markets public. It's accepting the technology as a lever to, expand the reach, expand the transparency of these markets, and, making them better. So, I'll say a little anecdote too. When I was working at UBS, and this was not that long ago, 5-6 years ago, whenever it was, we were still using, paper subscription agreements for a Blackstone private fund, watermarked, sent back over the mail, sticky notes and all. But 7 years later, here we are with, click to sign and, everything being digital and much more easy to facilitate.
Just think about I don't know if you guys have ever pitched angel groups, right? These folks, they source it from their group of angels that are in their club. And at best, they could see 30 to 50 deals a year at best, sourced from their network of people that are close to them. And then they have to make decisions amongst that bucket of 30 to 50 companies. We see right now in just the Reg CF and Reg A Plus markets, we're seeing almost 3,000 companies a year. Just think about that deal volume. It's from all over the country. It's all different industries, all different backgrounds. And it's not about who you know. It's the fact that the deal is available for investment on one of these marketplaces. The deal sourcing efficiency and the ability to see a far larger set of companies will just lead to the better results of, hey, if you see more deals and you have more access to more deals, you're probably going to drive to better deals and better investments over time.
Yeah, well, and the volume helps in a couple different ways, or cuts in two different ways. On one hand, the investors can see more deals and get better comparisons. I wonder, and I'm curious your opinion because you've obviously analyzed a lot of private markets. How do you think more liquid or more transparent private markets, more information, more price discovery, leads to or changes in the cost of capital for some of these private companies? No longer is it going to be public markets are 10 and private markets are assumed to be 20%. How does that erode that the cost of capital for private companies?
Yeah, it's so interesting. We've already seen over the last 20 years, the number of public companies has been cut in half. And the average time to go public back in the day, right, was about 4 years, like in 2000. And now it's 12 to 15 years. I mean, think about the fact that I don't know the exact market cap was on day one of Google's IPO, but I think it was around like $100 million. It was definitely sub $1 billion. Then you think about something like Uber that IPO'd for tens of billions of dollars, right? Like, it's just such a different return profile once these companies hit the public equity markets. And you're seeing there's just a lack of desire from private companies to want to go public. And if there is like incredible access to private capital, the reasons to go public become less and less and less over time. And so I think we're just going to see this shift where, basically instead of just having micro cap, mid cap, large cap, stocks, there's the private market version of that. There's, your pre-Cs, or there's micro cap private, there's mid cap private, and there's large cap private. And I think that's the world we're moving towards. In terms of cost of capital, day by day, this space keeps getting more sophisticated. When I entered this space, it was like, tell your customers that you're raising money, right? And now we're entering a phase where there are all sorts of really interesting agencies, whether it's a capital department or a Maverick Brands or a digital niche agency, and there's many more from there, that are really figuring out how to maneuver, soliciting for investment online, managing investor funnels, doing outreach via LinkedIn, like thinking of the modern approach to raising capital. And so cost of capital right now, I would actually argue is somewhat high, right? Whether you're taking from venture and taking tough terms, or you're taking in equity crowdfunding space and spending a lot to acquire those investors. But over time, I think we're just going to see those continue to drop as people figure out how to maneuver this space really efficiently. And of course, as you get more liquidity, there's more willingness on the behalf of investors to redeploy that capital into more deals.
Yeah, and it's interesting, there's been a lot of investment by the major firms. I think iCapital and Ares, was it? I think is starting their own platforms. But those are going to be. It's still not going to destroy the freedom of the whole private markets, because they're going to be focusing on their larger deals, things that they know that they can sink on. But then there's this whole untended arena of deals that are out there that are going to be on smaller platforms that I think like we started this discussion with. Investors are going to want to have a more personal or community relationship with who they're dealing with, because it's still going to be private markets. There's still going to be due diligence required. And there's this whole new chapter in terms of the capital markets that are going to keep a lot of these smaller middle market and sub-middle market deals open and untended by the larger players.
Well, one of the other things to note there, right, is unsurprisingly over the past 12 to 15 months, I've been approached a little more and more and more with organic outreach from financial advisors and RIAs. And what they all say is, hey, our younger clientele, they're asking for this. They want alternative investments. They're interested in it. But what do we get? We get either them handing us their friend's pitch deck for some random company and we have no idea how to evaluate it, or they're not bringing us anything and saying, can you bring something to me? And they're like, this is a really interesting avenue to be able to do this, right? Now, the challenge with that is that financial advisors and RAs, one, are incentivized by management fees, so they don't want to just like buy a service that they have to pay for. There needs to be a monetization path for them. And two is they're trying to put together your full financial picture, right? So the idea that they're just going to hop you into alternatives that they don't really understand is not going to happen. The most likely path for them to do that is for there to be fund products that they can offer where there's enough historical data to help them understand what the risk reward profile looks like so they can model that into the financial models they make for their investor base, right? So those are the things we're figuring out right now. We've built the first kind of pseudo index fund. It's not an index fund, but it's a venture fund hosted by AngelList where we're investing in 100 companies highly rated by our rating algorithm. And the idea there is to start proving out this model that A, we can manage money, and B, taking a data-driven approach in the private markets with these marketplaces built in that you can ultimately create, good returns for investors. And if that is possible, and we could start to measure and understand what that all looks like, then there's an opportunity to create these fund products that RIAs could charge for and provide to their end clients and say, we're giving you exposure to this basket of really exciting, interesting startups. And that's a future where I think, the inflows of capital start to really grow. Well, we can get buy-in from folks like that.
Yeah, it's a really exciting area. It's a big access point. People still like to trust their individual advisor, but they know what they want too, is greater access. When it comes to the advisors, them getting spun up on all the information, you talked about your proprietary database. I'm curious, right? Because Y Combinator, famous, they've got all sorts of decades of data on venture capital companies and what is a measure of success or what factors lead to success for various companies. How do you do that analysis for KingsCrowd and the types of opportunities that you see, and what does it look like to model out something like startup success or success when you give money to a growth stage company?
Yeah, absolutely. So the way that we've built our system is kind of from the ground up, rather than trying to peg and say, we think this is what leads to ultimate success. We decided to start from zero. And, one of the logics behind that, and it's, not really a knock against venture, but just a point to make is like, this is what leads to success. But even though we know that 90% of these things are going to go belly up, sure. It's like, so do you really know, or is this really just a guess, right? So I kind of argue that they haven't figured it all out. So my whole thing is like, let's not try and peg to something that's maybe fundamentally broken. So our focus has been on doing comparative analyses of similarly staged companies. So for instance, if you were a growth stage company between, call it 25 and 100 million in revenue, we're looking at that basket of companies that are active and raising capital at the same time. And we're going to look at things like your valuation and your revenue multiple and your burn rate and your market size and your addressable market growth rate and your growth rate on your revenue figures and the experience of the team and the gross margin levels of the business, so on and so forth. We're going to look at all the kind of key fundamentals that you should be looking at in a real business, right? And we're going to use that to basically be able to call out where there's red flags or challenges and where there's opportunities and upside for a business, and score on things like valuation, market size, team, growth rate, so on and so forth. And so we use that so that you can look at deals in a similar way across all, whatever deals you're looking at and say, okay, here's where the strengths are in this business. Here's where the weaknesses are in this business. So we feel like that's a really good way of, one, just providing a methodology to think about these deals, right? When I'm looking at early stage, I got 5 early stage companies. This one says they're worth 65 million and the rest say they're worth about 8 million. So, okay, where's the disconnect, right? Maybe something incredible is happening, but you better understand what that incredible thing is that's leading to such a high valuation. So that's how our rating system works, is it scores you on those key fundamentals. What we have found to date, and this is all paper gains, there's no results to speak of because it takes 10 to 15 years for these things to fully return, right? But what we're finding is companies highly rated by our rating algorithm are tending to go out of business. They are tending to raise at higher valuations on average than the rest of the market. And what I would argue is if you go look at the companies we're rating, if you go look at the 4.0s and above on our 1 to 5 rating scale, what you're going to find is those that are 4.0 and above, you're going to be like, yeah, these look pretty good. Like, there's no guarantees of success. They could still fail, all the things, but like these look really, really interesting. If you go look at the 2s and below, it's kind of like, yeah, I could see how there's a bunch of red flags and this is messy and I shouldn't spend any time here. And then, when you get into your like 3 to 4, that's where it's like, it could go either way, right? It's like, it might be an all right business. There's nothing major red flag, but there's also nothing to get super excited about, but you never know. But it gives you a really good set of parameters to think about these things. Now, the beauty of all of this is that we are tracking how the companies perform over time. We're tracking exits and failures data, IPO data. We get tons of customer feedback. on companies in their portfolio that are reporting to them and letting them know things. So we're doing a lot around that. But the reality is it's still going to take time for us to really see these realized gains, right? Like I'll tell you in KingsCrowd Capital, a portfolio, we have over 50 companies and a lot of them are doing exceptionally well. But very few of them in the last 2 years have gone on to raise more funding because they're doing exceptionally well. So we had, we could try and apply some rev multiples and things like that, but like
no
they haven't had to go, there's no true markup. So, there's challenges to all of this. And for us, we're playing the long game. The next 5-6 years, we'll probably be able to start giving you a really good sense of what that all looks like and start by having all this underlying financial data on every one of these businesses, be able to start building models around that and say, hey, we kind of know the ranges will be X to Y based on historical results.
Well, yeah, and I think there's a couple of ways to think about that mark to market, as we all talk about. One is, more liquidity from larger deals, more sales, more exits leads to more of that capital IQ data that you can comp to. But you talked about bringing more digital tools to private markets and having a secondaries market for a lot of these deals. Necessarily leads to more liquidity. Even if it's a partial share, even if it's a $10,000 share on a $20 million deal, that's price information that you can get. And there's always going to be a wider bid-ask spread, but it's much more narrow than, 5 years ago, this company priced at 10 and, 2 years ago, it priced at 20. So, average it. But it's interesting, where do you think, because the journal, Wall Street Journal, has been filled with articles, sort of poking fun at private equity and, big players or big LPs trying to get liquidity because they've been locked up for 10, 15 years in a lot of cases. How do you see the middle markets and these smaller deals potentially offering more liquidity, especially with secondaries?
Yeah, so one thing that happens when you have a lot of investors partaking in the market, right? Like what creates great liquidity in the public equity markets? There's millions of investors. Obviously, there's lots of institutions and whatnot that help too, but there's quite literally millions of investors partaking in that market that creates liquidity and movement. And if we look at this space, nearly 3 million investors have partaken since the start of the Jobs Act, right, when it was fully enacted in 2016. And most of those have come in the last few years. So the reality is we have a lot of buyers and sellers that should be in that pool. Now, as I mentioned, Start Engine, right? They're one of the first to kind of create a full ATS, which stands for Alternative Trading System, and a transfer agent, which is, how you make sure all the shares are owned by the right people and the records are in the right place, which enables a secondary market where an investor can go in and say, I want to sell my shares for X price or Y price. And then if there's a buyer, right, they'll be matched and the sale will be made. Now, right now, that market is deeply inefficient. There's very minimal information, and something we're working on at KingsCrowd is to be able to provide a lot of insights around pricing and what you're paying, and is it undervalued or overvalued, and so on and so forth. And we think that'll be really powerful to start creating movement, because what we're finding at the moment is that a lot of things get underpriced because people are just simply looking for liquidity and think if I underprice it, I'll be able to get liquidity, which if you're a thoughtful investor will go, this is a huge buying opportunity, right? If I have access to the information and how the business is performing and it's doing well, and I'm getting a discount on the last round, I'm going to come in. But I think as we start to make people aware and educate them on the fact that right now there's a huge opportunity to buy low on a lot of companies, it's going to start. Now people are going to, wait a second, there's movement here. All right, I'm pricing high. I'm going to price where it should be. And as we start to bring transparency to that pricing, I think we can drive to getting people, real liquidity and get real movement. And I will tell you, one of the other things we've talked a lot about is there are so many late stage secondary marketplaces, right? Whether it's a Forge or an Equities End, so on and so forth. And we're like, hey, we don't need more analysis on the fundamentals of Stripe or SpaceX. What we need is for people to understand what they're buying. Let's show them all the prices across all these different secondary platforms. And then let's provide an analysis of, all the fees too, right? Sometimes you're buying into an SPV of an SPV of an SPV, and there's all these fees built up where it's going to erode whatever return you may have had. And so we want to really start bringing that pricing transparency in a streamlined, consolidated way. We think that'll be a real driver to getting people to partake in the market. And if there's enough of them, it does create a velocity. And I think we'll see that in the next 3 to 5 years.
That's fascinating. It's just an iteration on an iteration of what we've been talking about this entire time. And, it almost reminds me of, when sports betting was made legal, and you could at times find these massive disparities between different sports books, and you make an arbitrage, a true arbitrage. But if we consolidate that information, then that arbitrage slowly erodes, especially if you bring the transparency. But yeah, going from starting your own website, reviewing these platforms, starting your own platform because you have all the inside baseball, to now consolidating the rest of these platforms, these derivative platforms, you might call them, about the secondaries market, and really always focusing on bringing information to your investors, and information not even to your investors, just to the users of your platform, has really been a thread that seems to be holding all of your the last 7 or 8 years together for you. I guess taking it all back, right? We've gone a long way across your entire history and what's exciting you about private markets now. But if someone is just starting out and maybe even focusing on someone that's skeptical of private markets, and rightly so, they're private, they don't have as much information. What would you say, to get someone excited about it and really set them off on that journey of discovery that you've gone through, and, just start learning about private markets and maybe taking the first step to investing?
Yeah, it's a great question. One of the things that I struggle with the public equity markets is, again, because of how late these companies stay private, right? The return profile of the public equity markets, I think, is really changing for the negative for individual investors. If you look at where wealthy individuals, family offices, and institutions are investing their dollars in pension funds, all of that, it's become predominantly private equity, private debt, private assets. And, they're not dumb. There's a reason they're doing that, is because the return profiles are really, really healthy there. And so for me, if we want to create the next investment vehicles to help the next generation build wealth, be able to take people from lower middle class to middle class to upper middle class, or, wealthy, right? We need vehicles beyond their income that's going to help them get there. I just look at my grandparents, right? Who came to the US from Italy with nothing. And when they passed, they were comfortable, right? They had done really well. And it was mostly on their housing stock and their investments in the bond markets and their public equities. And I don't think that exists quite in the same way today for this generation. So we need to find new ways to help them get there. And, it's a good example just to set the picture. I don't want to set any misexpectations, but if you had put $100 in Uber in its pre-seed round, right? When it IPO'd, you would have had $1 million, and you'd have even more now. Of course, that comes with a lot of risk, and most of these things are going to fail, and yada, 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 right? But the reality is, if you want to talk about a tool that could potentially lead to outsized returns that can really help you grow your wealth, this is a super powerful vehicle to do it. And if you get educated and you diversify and you make it a small percent of your overall portfolio, once again, it's just trying to set you up for success to give you the best shot at growing your overall investment portfolio and your overall wealth. So with all the caveats of risk and danger, and it could take forever, right, to get really good returns, if you're a long-term hold investor, this is a great vehicle when diversified to create potential outsized returns from my perspective.
That's an excellent way to put it. Follow the smart money in a lot of ways, and investing early and often with confidence and information. Well, Chris Lustrino, CEO and founder of KingsCrowd, really appreciate you hopping on today, talking about your platform, your journey, and what you're seeing in the private markets.
Thanks for the opportunity. Appreciate it.
That wraps up this episode of Multiple Perspectives. A big thank you to Chris Lustrino for sharing the story behind KingsCrowd and the vision driving the evolution of the online private markets.
Yeah, and as we saw today, platforms like KingsCrowd and Equity Multiple, they really help self-directed, accredited investors tap into the wealth-generating potential of private markets, private market real estate, private market credit, private market equity. And I think what's really important, and what Chris and I just discussed, is it's a lot of information that to digest and gather. But if you've got a structured way to look at it, and I think also beyond just the data, it's the people, relationships that really are impactful when it comes to building trust in the markets, building trust in the deal, and understanding that someone's going to be a good steward of your capital. And whether you're just getting started out or whether you're a seasoned investor, finding and maintaining those good relationships and finding the tools the software, the platforms that help you do that is going to be really, really important. And, if you're piqued in interest with investing on KingsCrowd or Equity Multiple, there's links down there for, accessing any of their platforms. And specifically for Equity Multiple, just reach out to my team at ir@equitymultiple.com.
That's right. And there's one special link down there. If you want to, as you're saying, Daniel, sort of continue this relationship, keep hearing from these people. Tell us about the webinar that you guys have coming up.
Yeah, that's right. Almost missed the best part. We've got a webinar coming up at the end of May, I think second to last week of May. We'll be sending out information for anyone who's interested and on our platform. I'll be hopping on with Chris again and discussing some of the benefits of private market real estate and some of the current trends that we see. And I think one of the biggest pieces that we talk about is the breadth of asset classes that you can get access to beyond just buying a duplex with your friends or living in one of the apartments. There's a lot of places to diversify, and real estate's changed from what it used to be in a very slow-moving profession.
And if you'd like to learn more about how real estate is continuing to change, how private markets are continuing to change, if you enjoyed what you've been listening to, and my guess is if you're listening still at the end, even while we're sort of talking through the credits here, please consider leaving a rating or a review for the show. It helps us grow our audience and continue to bring you sharp, actionable conversations with the leaders shaping the future of investing. Thanks again for listening. I'm David Lofgren. That's Daniel Brereton. Thank you, Daniel.
Thank you, David.
And this is Multiple Perspectives.